Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. We had one of the biggest and kind of craziest deals happen last night between Penn National and ESPN, which is majority owned by Disney, partnering on a long-term 10-year deal to basically promote Penn's sportsbook and gaming activities. As a part of that, Penn is ending its partnership or acquisition of Barstool Sports, which is basically giving back to Dave Portnoy. Now, this is a fascinating deal. There's a lot of ways to look at it. I'm going to do videos over the next week or so about the impact on ESPN and then the specific impact of the divestiture of Barstool Sports for Penn, because that I think that's really interesting to think about, in particular related to the cost associated with it. But I'll cover that at a later time. Today, I want to focus on exactly what this deal is and what the potential impact might be. My name's Travis William. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. If you enjoy this video, check out my newsletter, Asymmetric Investing. Got a link to that in the show notes. And I want to start with the presentation that Penn gave last night. This is just a quick overview of the partnership synergies that they see between the two. So basically, if you're watching sports on ESPN and you want to bet, why not partner between the two companies that are offering those services? That would be the way to think about this. Exclusive and integrated. Again, the betting is going to be integrated into ESPN shows. Maybe they'll talk about odds and things like that. But we've seen this before on ESPN and other sports networks. So just another integration. The value creation number is something that is kind of pulled out of thin air, but at least Penn Entertainment thinks that there could be $500 to $1 billion in interactive adjusted EBITDA potential. I hope that is the case, given the cost that given what they're going to be paying ESPN for this marketing deal. But we'll get to that cost in just a second. While Penn is a big company in gaming with regional casinos all over the US, the real reason to focus on this would be for that online gaming piece, the online sports book specifically. And you can see kind of what they're thinking about here is this advertisement right in the middle. When you're on the ESPN app, they're going to start integrating bets that you can make with Penn Entertainment. So that would be some of that integration. And then the data or customer interaction flows from ESPN to Penn. That is one thing that they said, is that they're not going to be sharing that data with ESPN. That's going to be something that Penn gets to keep. They do already have a 27 million customer database, and this is an omni-channel cross-sell deal. From this slide, this is really the benefits for Penn Entertainment. The benefit for ESPN is really about money. This is the details of the transaction. And for ESPN, the part to focus on is going to be the $1.5 billion in cash over the initial 10-year term. So figure $150 million per year. And then they're going to get all kinds of information to promote ESPN Bet. ESPN Bet is going to be the trademark that's associated with physical locations inside Penn Entertainment casinos. Penn will also get access to ESPN talent and personalities. And then the other piece for ESPN is they receive approximately $500 million in warrants up front. That, I think, is worth looking at exactly the details. This is the warrants, and you can see here there are 3 tranches of general warrants. These are 10 years in duration. So basically, ESPN has the right to buy 12.7 million shares at a $26.08 strike price anytime over the next 10 years. If we look at Penn's stock price right now, as I'm recording, $27.62. So based on that, ESPN has already made $16 million in profit just from this single tranche of warrants. There's another tranche, the tranche B, 12.8 million warrants for $29.99, and tranche C, 6.3 million warrants for $32.60. Like any option, if the stock price does not go above this price, then those warrants would expire worthless. So ESPN gets basically $150 million per year, and then also gets further upside if Penn Entertainment stock rises in value through these warrants. That's really the 2 ways that they're going to be able to make money on this deal. Like this says here, these do vest over 10 years. So these are not going to be something that ESPN is going to be able to sell next month, let's say, if the stock goes up to $35 a share. There's also performance warrants. This is related to the online sportsbook market share. If they get over 25% market share, they get another 2.5 million warrants for $28.95 per share. So potentially very big upside for ESPN. What's interesting in this deal is the level of investment that Penn Entertainment is putting into their online sports business. I think this is kind of a Hail Mary for them. They tried to grow with Barstool Sports. That obviously didn't work out as planned. And now they're turning to ESPN. This is obviously the biggest name in sports, so it makes sense to do that. But if it's not successful, you're out about $150 million per year. If it is successful, you're actually giving ESPN a whole bunch of that value through the value of those warrants. So you can tell in this negotiation, it was really ESPN that had the upper hand. From ESPN's side, I think this is really a telling sign that the company needs to generate more profit, needs to generate more money. Years ago, ESPN would not make a deal with an online sportsbook. That obviously has changed over the last few years, and this is another big step in that direction. Now kind of going all in on online sports betting with this deal with Penn Entertainment. There's potentially a nice amount of upside, $150 million a year coming in, got those warrants. But the downside is now you're going to dilute that experience because you're going to be talking about sports betting all the time on your programming, where that's maybe not why people are actually watching. So a lot of interesting dynamics here, but it's clear that Penn Entertainment was actually desperate to grow into this business before somebody else takes all that market share. And ESPN is in a position where they need money because they're going to have to pay for sports rights over the next decade. So this was a valuable deal for them from that perspective. A lot of nuance going on, and we'll see how this plays out. Pretty clear that these are two partners that needed each other. And now it will be interesting to see where some of these other sports networks partner potentially in the gaming space. What do you think about the deal? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.